Hey guys, Ralph here from the Endgame Investor, and something strange is going on in the spot gold contract. I've noticed it since January 11th, and I want to cover it here. I don't know exactly what's going on, but it's very strange. I've never seen it before, and hopefully I'll get Craig Hemke on the show this week to discuss it because he has some theories. But anyway, the point is that there's been heavy volume in the spot contract. The spot contract is the contract for current delivery. If you buy it, you buy it for delivery, because once you are long that contract, you are inside the delivery window, which means if your number gets called, you either have to make or take delivery depending on whether you're short or long.
All right! I'm a delivery boy!
The spot contract is not used to hedge. Futures contracts are used to hedge because you do not need to make or take delivery on those. You can keep rolling those over. So why is there huge volume in the spot contract now? Well, whoever is buying that contract wants physical gold, or at least the warrants for physical gold, and there is a whole debate on whether those warrants represent anything physical. But we have some evidence that this is draining the Comex by the numbers, and we'll go into that right now. The CME Gold Volume page for Friday, January 20th. You see here the spot contract, January 23rd. This is the first row here, and the total volume is 1,346 contracts traded. Now, the change in open interest, that means the number of contracts that were open on January 20th, was 1,068. I believe those are the numbers from actually January 19th. I think this is on a one-day delay, and I'll explain why in a second. Now, these deliveries, 269, that's 269 warrants. A warrant represents 100 ounces of gold that can theoretically be loaded out. But taking delivery is not the same as loading out, as I discovered when I tried to take delivery on a silver contract. I got the warrant, I did not get the silver. So same thing here. Deliveries means deliveries of warrants or titles of ownership to a specific bar, 100-ounce bar of gold. So 269 deliveries means that open interest should have closed by 269, because once you deliver, that position is closed and exchanged for a physical or a representation of a physical bar. The fact that 1,068 contracts opened on January 20th, despite 269 closures, means that the total amount of open interest of new contracts that were open is this number, 1,068 plus 269. So that's 1,337. 1,337. That is very close to the total volume, 1,346. Now, if we move to the deliveries page.
Delivery boy? No, not again!
This is the deliveries for January 2023. Let me make it a little bigger, shall I? And we have here January 20th, 1,337, the exact number of 1,068 plus 269. So those contracts were open and they were all delivered on the next day. Now you see here, if we go into the January 2023 delivery totals, we see here that, okay, so this is a little bit messed up. You have December 29th after January 20th. I think this is just like a glitchy kind of thing where the 1 comes before the 12. So it's ordered in this way, even though this is the first date. December 29th, 2022, you see 579. That was the day that the contract moved from futures to spot into the delivery window. So you have 579, which is a respectable amount of deliveries. And then the next day, 92, kind of tapering off. Then you have pretty much very low activity, 23, 10, 20, 19, 15, and then 122, and then bam, 1,149 on January 11th. That was the first day of major activity. Then tapered off for 2 days, 114.97. Then, oh, wow, you have another 711 deliveries on January 17th, another 1,424 deliveries on January 18th, and then another 269, and then 1,337 on January 20th. What is going on here? These contracts are all opened and delivered on the same day or one day after. Let's see here, if we go back to, let's see, January 19th, right? January 19th, we had 1,424 deliveries with a decrease in 1,055 open interest. But the difference is in new contracts open, because it should have decreased by at least 1,424. It decreased by less, which means more contracts were open, and you still see significant volume in the spot contract, which should have next to zero volume, especially at this time of month. And if we go back to January 18th, you can see here an increase in 313 contracts despite 711 deliveries, over 1,000, about 1,024 contracts were open, 1,027 volumes. So almost all that volume was in new contracts open and delivered the next day. We see the same thing on January 17th, the day before. 603 contracts open despite 97 deliveries. That is 700 new contracts open, volume of 706. Still major buying for a spot contract. And one more day. Even this is a big day. See 391 contracts open despite 114 deliveries. That's over 500 deliveries, 512 volume, almost the same. Now let me show you something else. This is the total amount of gold in the depositories at the Comex, in the registered and eligible depositories. So we see here that on a monthly chart, I want to see how much was taken out, how much physical gold was actually loaded out, the bars taken out and removed from the locker rooms or wherever it is. That total is 598,982, which equals about 5,989 or 5,990 contracts worth of gold removed from the vaults. And now, how many contracts have been delivered this month? Keep the number 5,989, 5,990, 5,981 total contracts have been delivered in warrant form in January. You have almost the same amount of contracts that have been loaded out of the vaults entirely. Could this be a coincidence? Yes, it could be a coincidence. But what is happening here is some bank or group of banks or different banks are for some reason opening spot contracts and delivering or taking delivery of those contracts. Why are they doing this?
But I don't like being a delivery boy.
And that is a question I do not know the answer to. But what I did read about Citibank, which I believe is involved in these spot buys, at least by this chart over here. This is the daily delivery chart for January 20th. It is now January 22nd. So this is the latest daily delivery data that has come out from the Comex. This is renewed every business day. You see here Citigroup is involved in 1,337 of the deliveries. They were issued by Citigroup, and here you have H, and I think that means house account. And on the receiving end, it was Bank of America Securities that got most of those deliveries. So these banks are trading warrants. I don't really know why or what this accomplishes, but these are both house accounts. There's an H here, so it's for the banks themselves, not for clients. But what I do recall is that Citigroup was one of these speculators that believed that the Bank of Japan was going to stop its yield curve control, which it didn't end up doing, but that doesn't mean it's not going to stop it soon. And they might be setting up for something. Maybe that's a stretch. I don't know exactly what is going on, but it is very rare. Now let's take a zoomed out look of what is going on in this contract ever since it became spot. This is a chart generated from the Comex for this contract. You see here in December, back when this was a futures contract, until December 29th, the January gold contract was a futures contract, which means it could be traded in and out without risking delivery. And you see here at the peak of its trading, it was about, let's see, this was 1,588 contracts, 1,556. I'm mousing over and I'm seeing the numbers over here in this corner. And then it becomes spot right over here, December 29th. And the volume goes to about 24, 25, 26, 24 contracts, very, very low, as should be in a spot contract. And then all of a sudden, January 11th, it jumps up to 1,236. And then it has remained elevated ever since. And a new record for this month, 1,346 contracts traded in a day for a spot contract. Something is going on. Now, fortunately, we don't have to be geniuses in figuring out the intricacies of some kind of a conspiracy that might be going on here. Because in the end, it doesn't really matter, because gold is at the base of the monetary pyramid. No matter how much of the crazy conspiracy or whatever is going on, you're able to figure out or not. And so we see in the price action that something is going on in the gold market. We see that things are going on in central bank balance sheets. They're all losing money. They're losing money faster and faster now. The money supply, the global money supply, the global dollar supply continues to fall. And if it continues to fall at the rate that it is, in Daniel Oliver's words, it's going to be the end of the world as we know it. Does that mean it's going to be on the society? No, it's going to be the end of the monetary system, because it will require one last pivot, and it is coming. It is coming soon. It could come any week, any month this year. but there is no indication that the Fed is going to reverse course until the monetary system begins to implode, and that will be the final reversal. We are headed straight for it. And whatever is going on in the spot contract for gold, I believe, is connected in some way. And that really is all you need to know in order to protect yourself from whatever is going on. This is Rafi of the Endgame Investor. If you enjoyed this video, then sign up for a 2-week free trial of the Endgame Investor or become my patron on Patreon, where I give a biblical angle on what is going on in today's monetary system. In this week's video, we'll discuss how the 10 plagues and Keynesian economics and econometrics are intertwined in ways that will probably surprise you.
Delivery for defrosted Wang? One time was funny, but every week for 10 years, not as funny.